Hi everyone, my name is Mingyan, and today I will be presenting the Trump tariff war, which is my case study for Ethics and International Finance Assignment 3. So this presentation explores how the 2025 tariff policy under the Trump administration reshaped global trade, affected exchange rates, and raised ethical and economic questions about protectionism and also global equity. First, let's start with the initial overview. In April 2025, the US government reintroduced broad import tariffs, reigniting trade tensions that had first emerged back in 2018 and 2019. This move sparked rapid reactions in global trade and currency markets. Economic models predicted that the US GDP will decline slightly, while consumer prices have increased, costing the average household about $1,200 extra. Essentially, these new tariffs revived an old trade war dynamic, one that had major implications for both global trade flows and domestic inflation. So why do these tariffs matter? First, tariffs raise import prices, reducing overall import volumes and often triggering retaliation from trading partners. This affects national current accounts and puts pressure on exchange rates as countries adjust to new trade balances. While in theory, exchange rate movements should partially offset tariff effects, in practice, the real economic cost remains high, especially for consumers and low-income groups. The IMF also warned that the 2025 tariff escalation has raised global uncertainty and downgraded short-term growth forecasts. In short, what began as a domestic protectionist move quickly became a global economic shock. To understand the 2025 tariffs, we need a little bit of context. Back in 2018 to 2019, the first Trump tariff wave imposed 25% duties on steel and 10% on aluminum, with China retaliating against USD 110 billion worth of American exports. This led to a 1.1% decline in global trade volume. Under the Biden administration, which is 2021 to 2024, some tariffs were eased, but focus shifted towards supply chain resilience. Then in April 2025, Trump's return brought a 10% baseline tariff across imports and higher reciprocal tariffs on China. The motivation was very clear, which is an American first agenda, political populism, and an attempt to revive US manufacturing, especially with a USD 1.2 trillion trade deficit in 2024. So as you can see here on the right side, historically, we've seen similar patterns. For instance, after the 2018 to 2019 tariffs, imports from China fell by 16.2% and the trade deficit narrowed by 17.6%. So the 2025 policy was both a political strategy and an economic gamble. Next, let's continue on with the current state of affairs, the global reactions to tariffs. The global trade environment has become tense following the renewed US tariff measures. China retaliated with 25% tariffs on American soybeans and electronics, disrupting major agricultural and tech supply chains. The European Union imposed 20% duties on US autos and aircraft, heightening transatlantic trade frictions. To minimize exposure, global supply chains are diversifying. Many firms have shifted production to Vietnam, Malaysia, and even Mexico. Market confidence weakened, as seen by a 4% drop in the Dow Jones after the tariff announcement. Overall, the IMF revised global growth forecast down by 0.3%, reflecting widespread economic slowdown, while commodity prices such as copper and oil spiked due to uncertainty. Next, let's move on to the IMF 2025 GDP growth forecast before and after tariffs. According to IMF estimates, the tariffs have led to a clear decline in projected GDP growth across major economies. The US forecast fell from 2.2% to 1.9%, reflecting slower consumption and higher import costs. China's growth was revised down by 0.4 percentage points, largely due to weakened exports and reduced foreign investment. Similarly, the European Union's growth dropped from 1.3% to 1.1%. Globally, the overall average declined from 3.1% to 2.8%, confirming that the tariffs have dampened confidence, reduced trade volumes, and also created ripple effects across interconnected markets. Currency and financial markets reacted sharply to the tariff escalation. The Chinese yuan weakened to its lowest level since the year 2007, signaling capital outflows and reduced investor confidence. The Australian dollar also fell to around 0.6286 amidst falling commodity demand. The US dollar initially strengthened with the DXY index peaking at 107.3 before easing on inflation concerns. Bond yields rose 40 basis points as inflation expectations increased, and the volatility index, which is the VIX, jumped 18%. These movements reflect how tariffs raise import costs, push up inflation, and trigger exchange rate realignments consistent with the purchasing power parity theory. So let's talk about the winners and the losers in the US economy. In the US, the effects of Trump's 2025 tariffs are mixed. Some industries benefited, while others bore the brunt. On the winning side, domestic steel and auto producers gained from import substitution and local demand, but most sectors lost out. Agriculture took a major hit. California's farm exports fell by 15% after China's retaliatory tariffs on soybeans and almonds. In manufacturing, higher input costs from imported components squeeze profit margins. Meanwhile, retail prices climbed about 3%, adding around USD 1,300 to the average household's annual expenses. This drove headline inflation up to 2.7% in June 2025, compared to 2.4% the previous month. Overall, tariffs created a broad-based inflationary shock. So on the right side here is the global impacts table, which shows the ripple effects were equally significant. China saw exports fall by 8.5% and the yuan depreciates by 3%. The European Union experienced retaliatory friction. Exports of European Union-made cars to the US dropped by 4.6%. For Australia, weaker commodity demand caused a 5% export drop and a softer Australian dollar. However, Vietnam and Malaysia emerged as unexpected winners, benefiting from trade diversion and rising foreign direct investment inflows. Vietnam's inward stock grew by about 13% annually. Globally, world trade volumes shrank by 1.8% and Asia's GDP growth slipped by 0.4 percentage points, though Asia's gains partially offset China's slowdown. In short, the tariffs reshuffled global trade dynamics, favoring smaller emerging economies while weighing down the major players. Following the 2025 tariff escalation, several key macroeconomic indicators shifted sharply. The US trade deficit narrowed by roughly 7%, dropping from USD 860 billion to USD 795 billion. This is mainly because imports declined due to higher cost. However, this benefit came with side effects. Inflation surged to around 4.4%, reflecting rising import prices and disrupted supply chains. Globally, the ripple effects were visible in the currency markets. The Chinese yuan depreciated by 3.6% and the Australian dollar by 4%. This shows reduced trade confidence and lower commodity demand. The World Trade Organization reported that global trade growth slowed to just 1.1%, confirming the systemic drag of tariff shocks on global trade activity. So this table and the line chart here illustrates the gradual narrowing of the US trade deficit between the year 2023 and 2025. Across each year, we can see a steady reduction from an average of about USD 67 billion per quarter in 2023 to around USD 56 billion by mid-2025. This pattern reinforces how import compression temporarily improved the trade balance. However, while the numbers suggest progress, it's important to note that this improvement came mainly from reduced imports, not necessarily stronger exports. This distinction highlights the short-term and unsustainable nature of the trade balance gains under protectionist policies. The tariff policies affected different sectors unevenly. The steel and automotive industries saw short-term benefits through import substitution, with domestic producers reporting higher profitability. However, the agriculture sector was among the hardest hit. US farm exports, particularly soybeans and almonds from California, dropped significantly due to China's retaliatory tariffs. In manufacturing, imported components became costlier, adding pressure on production cost. For retail and consumers, the impact was immediate. Inflation rose by about 3%, costing an average household around USD 1,300 extra annually. The CPI continued to climb, confirming persistent inflationary pressure. Meanwhile, US exports to China fell 3% to USD 143.2 billion, reflecting a cooling in bilateral trade relations. So now let's look at the economic transmission channels. Here we look at how these macro and sectoral effects transmit through the economy. The basis mechanism follows. Tariffs raise import costs, which feeds into higher consumer prices, leading to overall inflation. This inflationary uncertainty caused the Federal Reserve to delay rate cuts, triggering volatility in the US dollar. The foreign exchange spillovers were also notable. Currencies like the Australian dollar and Brazilian real weakened as global demand softened. Emerging markets faced capital outflows, amplifying financial volatility worldwide. Although the US trade deficit temporarily narrowed, studies show that import substitution remained partial, suggesting limited long-term structural benefits. So the line chart data below from Yahoo Finance further supports this narrative. It shows that the US dollar index spiked to around 108 mid-year before stabilizing, reflecting the market's uncertainty around policy and inflation. So now let's look at the theoretical discussions, economic applications. So in this section, we apply 4 major open economy models to the 2025 tariff episode. The first, which is purchasing power parity, suggests exchange rates adjust to equalize price levels. Here, tariffs raise domestic prices and real exchange rates must adjust, and indeed empirical work finds purchasing power parity deviations widen under tariff shocks. Next, interest rate parity. Inflation expectations being elevated caused the central bank to hold policy tight, driving short-term USD strength. Third, the balance of payments framework shows that while tariffs may temporarily improve the current account, they are often offset by capital flow rehearsals. Finally, the Mundell-Fleming model reminds us that in an open economy, a fiscal shock like tariffs crowds out investment and constrains monetary policy, which limits flexibility. So together, the flow reads, tariffs goes up, then prices goes up, then purchasing power parity goes down, interest rate parity shifts, and balance of payments imbalance, and then FX volatility increases. So now let's talk about the ethical and technological dimensions. First is ethical impacts. Tariffs raise costs for consumers. For instance, CPI increases of roughly 3% in affected jurisdictions. Developing nations lose export income and face FX pressures. Tariffs also hit lower income households the hardest. Second is tech mitigation. Emerging technologies offer relief. Fintech platforms automate cross-border trade finance, reducing friction. Blockchain enhances transparency and traceability. Digital trade finance platforms cut transaction costs and expand access for SMEs. So the key takeaway is, protectionism isn't just an economic issue. It touches ethics and global equity. To navigate it sustainably, we need technology and ethical finance frameworks advancing together to offset the unequal burdens of trade disruption. Let's move on to the policy recommendations. Here, we wrap up with practical steps for key players. For the US government, instead of broad-based tariffs, adopt targeted industrial policy in high-impact sectors like semiconductors to safeguard innovation without sparking global retaliation. The US should also push for multilateral World Trade Organization agreements on digital trade and green subsidies to rebuild cooperation. Finally, coordination between fiscal and monetary authorities remains vital to control inflation and manage USD volatility. Next, for Australia and its trade partners, the focus should be on export diversification beyond China and the US, strengthening currency hedging tools and leveraging regional frameworks like RCEP for stability. Fintech-based cross-border settlement systems can lower transaction costs and boost efficiency. And as for global institutions, the IMF and WTO must tighten enforcement against unilateral tariffs and enhance dispute resolution mechanisms. They should also expand stabilization funds and technical assistance for developing nations grappling with FX volatility. Overall, these steps can rebuild trust and restore balance in global trade. So to conclude, the resurgence of protectionism, especially with Trump's 2025 tariffs, has reignited large-scale trade barriers, straining supply chains and reshaping global trade flows. From an economics lens, tariffs drive price hikes and exchange rate fluctuations, as shown through purchasing power parity, interest rate parity, and balance of payment analyses. But beyond numbers, ethics and equity matter. Higher prices hit low-income consumers the hardest, and developing economies face added FX pressure. Technology offers hope. Fintech and blockchain are already enhancing transparency, efficiency, and cooperation in trade finance. The key takeaway is, sustainable global finance demands multilateral cooperation, targeted policy, and digital innovation moving hand in hand. Protectionism may be resurging, but smart, ethical, and tech-driven strategies can balance it for a fairer global economy. That's it for my presentation. Thank you for listening.